Hello, and welcome to the PRGX webinar, Valuable Use Cases for Enriched Advanced Analytics and Source to Pay. Before we begin, I'd like to cover a few housekeeping items. If you have any questions throughout the webinar, please submit using the webinar question box to the right of your screen. Also, if you'd please check your audio, and if you're having any trouble hearing us, let us know also via the question box. And please be sure to follow us on our social channels, Twitter and LinkedIn, by searching PRGX Global. Today, we're pleased to have Daniel Ebert and Adam Moore join us. Daniel is the Senior Manager for PRGX's Advanced Analytics Solutions business with over 8 years of consulting experience. His expertise includes global working capital, retail merchandise and TrueNet cost analysis, M&A synergy capture, customer assortment analytics, and he has experience implementing DPO improvement programs with numerous Fortune 500 retailers. Adam is a principal for PRGX's Advanced Analytics Solution business and has over 7 years of consulting and 10 years of recovery audit experience. His areas of expertise include global working capital, retail merchandise and funding analytics, M&A synergy identification and capture. He has his undergraduate degree from Eastern Illinois University and his MBA from Purdue University. Welcome, Daniel and Adam.
Thank you, Michelle. So today we'll talk about a couple pieces of enrichment that we use to help our clients. So I'll walk through the parent-child mapping, and Adam will discuss the supplier fact packs. And then we'll discuss how this enrichment kind of ties in with a couple of service offerings that we have. So Adam will walk through the TrueNet cost and supplier and category margins, and then I'll take you through our DPO and working capital capabilities. So before we get into the actual content, here's just some background on who PRGX is and how the topics that we're going to discuss today kind of fit into the services that we offer. And so our primary clients are retailers, and over the past 50 years we've collected and ingested and analyzed tons and tons of data ranging from vendor masters to PO to payment to funding and deal data. And so the main service that we offer that drives the majority of our revenue is our recovery audit business. So whether it's identifying overpayments or duplicate payments to suppliers, or even catching allowance discrepancies where our client didn't capture the full benefits from a certain rebate. So that's our primary offering. And then a secondary offering that we have is based around our analytics, and that's where Adam and I come in, and that's what the focus of today will be on. And so the value prop there is, since we already have all this data from our retail clients, and we have, tons of people and SMEs that already know this data because they're working in it every day, we can take it a step further and offer analysis and visualization and sometimes consulting services as well around their working capital and margins and spend categorization to help improve their category performance. So it's kind of just a backdrop before we dive in. And so moving to the next slide. And so, creating a master parent-child mapping and keeping it updated on an ongoing basis is a best practice. And, it's one of the first things that organizations should do internally, or any consulting firms should do when they're starting a client engagement. And so most of the clients that we deal with are huge multinational organizations, and they have multiple ERP systems due to them being in multiple regions geographically and also through merger and acquisition activity. And so the larger they get as a company, the harder it is to accurately, track all the disparate information because these parent-child relationships are so fluid and they're constantly changing, especially as these big suppliers are acquiring smaller ones, and we're seeing that, more and more as of late. And so a couple of real-life examples that we have that we usually come across for, all of our clients, because these are such major suppliers, and we wanted to show one indirect or expense or goods not for resale supplier, then one direct supplier. So we chose IBM for indirect. And, so IBM has obviously been around for a long time. There are different name variations, such as the acronym IBM, and then International Business Machines spelled out. And they, provide services and software and hardware. So those could all be entered differently into our clients' ERP systems. And they're also, a global supplier as well. So our global clients buy from them in different regions. And so that's just core IBM by itself, even, without considering all their subsidiaries, such as Red Hat or Cognos. So, just looking at the names themselves, you wouldn't know off the top of your head that all these different subsidiaries under IBM are under IBM. And so we utilize, third-party databases such as Hoover's. We do our own internal research on annual reports and investor relations pages, and then we kind of keep a running global master parent-child list that we continuously update and reference, based on all of our clients. And then for a direct supplier, we show Newell brands on the right. And so, they own a ton of household consumer brands such as Elmer's Glue and Rubbermaid and Sanford. And again, it's super important to be able to identify these as children's suppliers just so that we can measure, total parent performance and make sure that when our clients go to the negotiation table with these suppliers, that they have the full picture of their spend and metrics with these large companies. And then moving to the next slide. So, here's a high level mapping process on the left that we do. And again, it's important that you utilize all the vendor master files and other sources just to compile all the possible instances of a parent vendor. And then once you believe that your review is complete and thorough, you can actually have the client review it, at least the top 50 or 75 or 100 parent suppliers by spend value, just so that they can catch anything you may have missed. And, most times when they review, they're seeing these parent-child relationships that they didn't even know existed at all. And that's where, the value comes in. So now they get a full picture of their business with these suppliers. And so, how does a robust parent-child mapping specifically help an organization, right? So it definitely helps with your overall spend cube and strategic sourcing, but what I'll show you later on in this deck with DPO and working capital is, we oftentimes see that terms are inconsistent within the same parent-child relationship. So, a child vendor may have worse or lower payment terms than their parent, and there may be an opportunity to harmonize or extend to the longest term. And it also helps with supplier segmentation. So, typically at the highest level, you can segment your suppliers as strategic versus non-strategic, right? And your strategic suppliers have more spend, and you can typically classify them as making up, as the top 80 or 90% of your overall cost of goods sold. And you can't really accurately group spend unless you do a parent-child exercise at the beginning, right? And so this segmentation is important because when you're rolling out a DPO program, you treat these suppliers differently, right? So you typically negotiate with your strategic suppliers, and it's a more drawn-out process trying to increase terms, while, for the non-strategic supplier base, you might just do a phone call or send out a letter that might be sufficient enough to change terms, right? Because there's going to be maybe less pushback. So that's on the working capital front. And then, what Adam will show you in regards to supplier funding and margin is, it really helps with seeing the complete picture and then generating accurate benchmarks and tracking performance over time, especially in the data visualization and reporting services that we offer. So, instead of manually looking at all the disparate children vendors separately and trying to compare, year over year funding, for example, it can be viewed all in one place with one filter. So, for example, filtering for Newell brands alone, you can just see the total parent company overall, and then you can see all of its underlying children and subsidiaries, and then be able to, track sales and COGS and funding and margin over time fairly easily. And that's when you can start to notice, certain trends and develop actionable insights and see kind of the high performing and the low performing children vendors come to light. So, by itself, parent-child mapping doesn't automatically just generate savings, but it does lead to better transparency and helps prioritize where the efforts should be focused. So, Adam.
Thanks, Dan. So next we want to talk about the fact packs. And I think as we go through the parent-child relationships and fact packs, I think the thing that we're trying to build is that we know everyone is using analytics at some capacity, and what bringing more enrichment to that analytics does is just help bring additional insights to the table that will make those fact-based decisions more actionable. Because as we get through and as we work individually with different sets of data, sometimes there's enough data looking with just a few pieces of data to make a decision, but in other cases that data is not enough to really make that ultimate decision or to support the decision that needs to be made. And so that's again where fact packs is an opportunity for that data to be enriched to further generate value from the analytics that we're using. So in the fact packs today, what we wanted to talk about are kind of 4 different pieces of information that could be brought together. And when we talk about fact packs, we're really focused on the large publicly traded suppliers, whether we're talking about a CPG or if we're talking about an indirect supplier like IBM we mentioned. All of that information there's a lot of information about these companies that's publicly available. So we'll talk through this with the annual reports. There's just really getting that picture of what is that company doing in terms of their strategy. What are some of the key initiatives that they're taking that might impact my relationship with them or my ability to negotiate with them. So that's a lot of information that we could capture from the annual reporting. As we get into the financial data, that's where we have an opportunity to see how is that company doing financially? Are their sales increasing? Are their margins increasing? How are they performing outside of their relationship with my organization? And so that's where we can start bringing in some of that information to help us support our data and our analytics to make better decisions. And then with earnings, these are publicly traded companies, so every quarter they have their earnings on their financials, and then within their earnings there's typically an earnings call and an earnings presentation. And what's great now is that all the earnings transcripts are available online. So it gives us an opportunity to really kind of get a quick vantage point as far as what's going on with them now. What market conditions have changed since their annual report, and how does that impact my business and my relationship with them. So that's another opportunity for us to capture specifically for a supplier. And then lastly, what isn't necessarily supplier specific, but what does impact the supplier's input cost is the commodity market. And so we think that bringing in that commodity data, we know a lot of organizations do that today, but having a true picture of what is happening with the commodity pricing of these component ingredients that go into the product, what's happening in those that may drive up the supplier's cost, which is ultimately going to get passed on to me if I'm a consumer or a retailer purchasing from that supplier. So having good visibility into that is just really helpful in analyzing what may be happening down the pipeline as prices are increasing, and if the prices are alternatively decreasing, when can I expect some of the cost concessions from my suppliers? So that's some of the information that we want to get into with the fact packs here. On the next slide, this is again some of the sample deliverables that we would do, and then some of the insights that we're able to generate on this. So again, kind of repeating some of what we do, getting key insights from a supplier is very important. When we look at their annual reports, we're looking to identify what kind of M&A activity are they going out there and doing? So, one, it's going to give us the information that says these are the types of companies that they're acquiring, and oh, that happens to be one of my suppliers as well. So it gives you visibility into that consolidation of a supplier's business and just the supplier community, just to give you that information to make decisions as you talk to that supplier. The other thing that is interesting in these annual reports is what risks are they communicating to their investors that may ultimately come down the line to you. So if they're out there saying that this specific commodity, we expect the price to increase, which is going to increase our costs, that's information that we want to see before they're coming to us in a negotiation saying that we're increasing your price. Like, that's insights that we could capture earlier on in the process to see that this is how I could expect them to be coming at me in the future with some of this information. And then lastly, it's just organizational strategy. Like, what are they focusing on internally as strategic initiatives? Like, and does that strategic initiative impact my business somehow? Are they focused on moving to certain product types, or are they focused on doing just operational efficiency processes internally that really don't impact me? But what are they doing as an organization that might give me a little bit of an advantage, knowing that as I communicate and talk to them through the negotiation process. Next, we have the financial performance, and this is really kind of an insightful thing. Like, we have, as an organization, you all have your own information as far as how much you're spending with that supplier. If you're a retailer, what are your sales with that supplier? What are your costs, and what are your margins with that supplier? So what's really insightful is that if I'm a retailer and I'm looking at my financial performance with this CPG, as I see my sales go up and my margins go down, it kind of gives me a question like, well, is that normal or not? And so that's where some of this financial performance data would give you an idea of, well, how is the supplier performing? Like, is the supplier sales across the globally, are they going up, and are the supplier margins going down like mine? So it gives you insight into what is actually going on in the complete market with that supplier to see is there something a little bit off with my data. So it's kind of like an opportunity to benchmark your performance with that supplier to the market performance with that supplier, and really see that are your sales and are your margins moving in the same direction as that supplier. Then next we have the operation efficiency, and that's we'll get into some examples here, but really it's kind of like, okay, what is their days payable outstanding? What is their day sales outstanding? And how is that changing on a year-to-year basis? Because operational efficiency is important to any retailer, any customer that may be buying from these suppliers. So how are they treating their suppliers and their other customers, and does that mirror like how your terms are being generated? So it just gives you a good vantage point to see, like, is my DPO connected to their DSO, or is there a big gap? So then once we compile all this data, so like we're pulling all the publicly traded suppliers, it gives us an opportunity to start comparing those suppliers against each other, just to like Dan said, like we could start segmenting suppliers into specific industries and specific categories. So as I look at a particular supplier, I'm able to compare their operational efficiencies to some of their peers to see is there consistency in that, or is there a trend in the overall market that I really want to leverage in my negotiation. So all that information is just giving us various insights that we can utilize as we mix this information with our own analytics, right? So we want to compare again their sales and margin performance to our sales and margin if we're a retailer. We want to see are their service fees increasing while ours are decreasing, or vice versa. Like, we want to see how is that related to our business, and if we have a payment term initiative, like we want to be able to look and see how are they treating other suppliers. Like, is there opportunity or not based on their DSO across the world essentially, or the market. And then, what activities are they going through? Like if they're getting ready to spin off a division, like, that's information that we would like to, know ahead of time, just so as we go through the negotiation process, we're kind of aware that, yes, this division might get spun off at some point, and that might change, some of the terms we have with that piece of the business. Okay. And then, lastly, I think one of the key insights, especially, in today's environment, is, what channels does that supplier participate in? Like if it's a CPG, are they, just in the retail channel? Are they in the, hospitality channel and the restaurant channel? Like what channels do they participate in, and how does that impact their business with market fluctuations? So that's a good insight to, capture as well from, whether it's their annual report or their quarterly statements. There's a lot of information in there that would say we see risk in this channel, which is going to drive our performance in this direction. So that's information that's valuable to know as we work with that supplier. Okay. So next we have an example of kind of what a full backpack might look like in a report view. So this is an example like we used and built with like Coca-Cola. So on the top, we get some of the visualizations to see that performance, that high level performance of the sales, the margin, the operating margin, and like their cash conversion cycle. So it's like, here's some visuals of how they're performing, and we could see the visualization kind of right to left being like 2012 to 2016. We could see their sales are down, and then we could kind of unpack that by looking at some of their key insights, like, okay, what is driving some of their sales performance down. But then as we look at that, next we have the margins, like, okay, well, sales are down, but the margin, is still, consistent. So we could start comparing that information to our own performance with them, to leverage that information. So we have the visuals on the top and then the detail on the bottom. And, like anything, like historic data is very valuable to any of these analysis. So we could see that trend and then, apply it against our own trend. And then lastly, just kind of the key insights, like, just, what's going on. Like this one's a couple of years old. So it's like, okay, 2017, they announced a new CEO. So it's just kind of information that's nice to have, just so you kind of know, what is going on, with that specific supplier. Okay. So next we want to start talking about like, okay, how do we take enriched data, whether it's from the fact information or the parent-child, and apply it to like our own, analytics. So on this slide, like what we wanted to present is just one of the services that we provide is true net cost analytics. And what true net cost is really mostly related to retail, but in retail there's a significant variance between what the invoice cost of the product is versus what the true net cost of that product is. And what drives that significant variance is the supplier funding that is provided to retailers to help promote the product. So when we see advertising and so forth, like that's being supported by supplier. So in the true net cost process, we're taking that funding and allocating it down to the item level, so we could really see what is our true margin of that product and what is that true cost. So when we start to negotiate, we could really help identify what our opportunities are in that negotiation process. So, illustratively, we have an example here of a bottle of water. It's like if we just look at that invoice cost of that bottle of water, it may be $3.24 with no funding. As we start applying the funding to that product, we see that it goes from $3.24 to $2.97. So now we have, that roughly 30 cents is creating a significant difference in what our margin rate would be before and after that funding. So having that information is really giving us the full picture and the full opportunity to utilize that analytics in a fact-based methodology. So now that we have like that true net cost built, that's where we could start applying some of the other enriched data to really take the full benefit of that data and make the best fact-based decisions in our negotiation process. So on scenario one here, like this is where like we have, we're illustrating as if we're a retailer, right? So we want to see like, okay, what is our contribution rate for that funding from a supplier, and how does that relate to a supplier's overall performance? So one of the things like we would build out in this process on the right is saying, again, looking at that year-over-year data, like how is our funding changing from one year to the next. So we have our illustrative numbers here saying, okay, our sales from 2019 to 2020 went up. So that's again like something that we see in retail today, like with COVID in the U.S. Like we see sales on specific retailers like grocery and so forth, where the sales are going up because the demand in the market has changed. So as we look at that, it's like, great, our sales are up, that's great, and our funding on a dollar for dollar basis is up. So at a glance, it looks like everything's positive. But as we take that analytics and say like, okay, well, what is our percent of funding against sales in 2019 compared to 2020? And that's where we start to see the opportunity. Like there was a relative change in our funding from 13.75% to 12%. So on the right hand side, we could see the visualization of that in the red box here. Is like, okay, that funding for this supplier is going down compared to the previous year's history. So as we see that, like if that's the only analytics that we have in place, like we could still use that to generate opportunity. So we would look at that and say, okay, well, if we were able to capture that relative change of 1.75%, that represents an opportunity of $175,000. So just with that information alone, it gives us direction to have value to go out and capture. So there's no problem with that. We could start having a conversation with the supplier to say, hey, these are our numbers. We see that we'd like to try to capture this $175,000. But with just that information alone, like we open the door for the supplier to throw a lot of responses back at us. Like they could come back and say, well, with the market conditions, we really don't think that we're going to be able to support that. They could give you 50 different reasons why that request can't be supported. So bringing in that enriched data gives us that advanced viewpoint of, is this an opportunity and is it capturable? So on the bottom, like this would be illustrative of what we could find out from their financial performance data is looking at, okay, well, before we go out and ask that question, what do their sales look like during this time period? And what does their margin look like during this time period? So in this example, we could see that, okay, yes, their sales increased well, along with ours, so that's a good box to check. And then the other box is like, okay, at the same time, their margin went up. So if the supplier's margin's going up and their contribution rate to us is going down, it creates more of an opportunity for us to support that ask and say, well, your margin's going up, most likely because you've cut funding. And that's where we would like you to reinvest in the business. So it just gives you, more opportunity to pinpoint the action that you're going to take and have that fact-based information to really support what you're asking for and eliminate just the casual responses that a supplier might throw back at you to say, yeah, we really can't help you there. So that's where that type of analytics combined with that enriched analytics really give you different opportunities to capture. So next scenario is scenario 2. So this is, again, like looking at the parent-child relationship and how does that enrichment, give us, different insights and opportunity. So one of the areas of enrichment that, we see in, whether it's parent-child master or just data alone, when we, work with clients to build out this analytics, like we integrate and harmonize all the different ERP systems that are out there, because as our clients are going out there and acquiring businesses and running across different regions with multiple ERP systems, it's really hard for somebody to run a report within a client and say, here's our total spend for this supplier across all these regions and includes all the related subsidiaries of that business. So that's where the enrichment of the parent-child and the data again, helps us bring some of that information together to allow us to get to the answer a lot quicker. So on the left-hand side here, we look at, this supplier, Newell Brands as an example. We look at that supplier without enrichment. So, if somebody comes to you and says, what is our total spend and margin with Newell Brands? Right now, like if you don't have this enriched data, it's a multi-step process of going out there and figuring it out. So in the previous example, like we listed that, let's illustrate that there's 8 different supplier IDs in Newell Brands within your organization. So if you're going to identify that total sales and total spend and funding, like you're going to have to, one, identify all those unique IDs. And as we see in the example here, they're not Newell Brands and Newell. It's, you have totally different names out there like Sanford and Rubbermaid that may exist in the system. So one simple search is not going to bring those together. So the first step is to, one, identify those. So that takes a lot of research sometimes to go out there and see, okay, what is part of this company, what's been spun off, and so that takes time alone. Then as you get that information, then you got to go out into the system and query each one of those instances. Like I need to look and see if Elmer's exists, if Jardin Home exists, if Rubbermaid exists. So there's a lot of trial and error in your query to identify where these suppliers exist. And in step 3, in the cases of there being multiple systems, like one, you got to search that in 2 different systems. And then even if you identify that supplier in multiple systems, the data may not look quite the same. So it's like, okay, here's my report from system A, and here's my report from system B. Now I have to kind of aggregate that together and match it up so I could start doing some totals on it. So that's step 3 that becomes a challenge. So once you get all that information, now you're aggregating totals and starting to build it out. But it's not as simple there because your sales, COGS, and funding are likely in different systems. So you have to repeat that step 1, 2, and 3, and 4 across each different system to collect all that different data. So just as long as it took me to explain it, it takes 100 times longer to actually do it in reality if you don't have that information aggregated together and enriched. So the alternative is if you have that data enriched, now I have a parent of Newell, so I could search Newell, and as I search that, it's automatically linking in all the enriched parent and child suppliers of Newell. So I could see that, okay, in our organization, under Newell, we have 8 different vendor IDs that would roll up to that parent. So as I search that, the reporting is developed in a way that it's going to allow me to search that to see, okay, what is our sales and performance with Newell, and then on an individual basis, still have the visibility to see, well, how does each child perform individually? And so in this example, as we build all that out, so as we go to talk to Newell, one, we have clear visibility of what does Newell mean to our business. So with these illustrative numbers, it's like, okay, Newell, we have $27 million in sales that come from Newell. We get $5 million in funding from Newell. And all in, Newell provides us with a 26% margin. So at a top line, top to top meeting, we have, here's everything about Newell. And then as we start drilling into the children of Newell within our organization, we could start seeing which children suppliers are performing or outperforming the parent. So as an example, Jardin Consumer, we could see that it's generating 40% margin. So it's like, okay, that's one of the better performers under Newell. And then we look at Rubbermaid, and again, illustrative, it's at 16% margin. So as we start communicating and building a strategy with Newell, we kind of apply where our focus is. So like Jardin Consumer, it's at 40%. It's not really hurting us right now. It's one of the good ones. So we don't want to apply our focus on getting benefit out of Jardin. But if we look at Rubbermaid, that might be one where we want to drill into it and see how can we improve our performance with Rubbermaid. And so that's where we can really start looking at that detail to identify what piece of the business do we want to focus on. And so that's really what that, parent-child allows us to do, is see the full picture and then really pinpoint where the opportunity exists. And we take this in the analytics that we build out, we take this down to an item level. So as you go into the specific Rubbermaid, you can start drilling into the different categories that they represent in the business and compare that category performance to the overall category performance, and really start pinpointing what specific items are really driving this lower margin, and what specific items can we take action on to improve our margin with this Rubbermaid child to increase the overall parent margin. So that's really the opportunity and visibility that we start to generate having this level of enrichment to our analytics. So with that, Dan's going to take over with some examples on the days payable outstanding.
Yep, thank you, Adam. So if a company is wondering how they stack up in the industry, or if they're wondering if they should start a DPO improvement program, they can actually use public financials to at least give them a directional gauge of how they're doing. And so we would oftentimes do this as well when we're trying to sell our services to potential clients. So this is before we even start a client project, and this is one area where a fact pack can help with working capital. So here's an example of an analysis for a Mexican company named Herdez, and they're actually not a retailer, but they're a supplier of processed foods and salsas and yogurt and ice cream. So, obviously they have a lot of good competitors out there that we can compare against. And so their DPO a few years back was 34 days, and you can, calculate that using the accounts payable balances on the balance sheet, and then also the COGS, or cost of sales, line on the income statement. So 34 days was fairly low compared to others in the industry, such as Sigma Alimentos, who is down in Mexico. There's other global firms such as Unilever and Kraft Heinz and Mondelez that sell a similar product mix as Herdez. So they did outperform Grupo Bimbo, but they have a little bit different of a product mix where they're selling more fresh items like fresh bread. So that's why it's pretty important when you're creating this chart that you select companies that are true competitors, and also you can qualify it as it's directional. It doesn't tell the full story, but can be a very powerful way to at least start the story or get your foot in the door, right? So Herdez is only at 34 compared to the industry average of 55. And when you start attaching like actual dollar figures to it, it can actually, catch more attention to some of these CFOs. So if Herdez, eventually matched that 55 days, it could yield over 1 billion in Mexican pesos in increased working capital and cash flow. And, obviously that's important, right? So if they're deferring payments to suppliers overall, they're managing their short-term cash better, and then they're freeing up the cash to service other projects internally or other expenses, or even, paying off other large suppliers with shorter terms, perhaps. So, they can invest in the supply chain and even give back to their own suppliers. So it's just a net win when, you extend terms internally with your suppliers. If Herdez wanted to get really ambitious, they could shoot up for the upper quartile on this chart, which is 73 days, but obviously, that wouldn't be as realistic. So, it's important to measure against your competition, but it can also be telling to measure against yourself as well, historically. So, if you look at the chart on the bottom there that compares quarter over quarter DPO, you can actually track yourself and try to match recent historic highs if possible. So, for example, if Herdez was at 32 days at the end of Q3 of 2017, but just a year prior, they were at 35 days. If they matched that, they could yield, really positive cash flows. One trick with quarterly analysis is, it's shorter term, so you have more ebbs and flows, and sometimes companies can even try to manipulate it to make their DPO, seem higher at the end of the year for reporting purposes. But, it does help to see if you're trending in the right or wrong direction over time. Okay. So, this is where parent-child relationships can really come in handy, when you're looking for quick wins to extend terms and working capital. So this is an illustrative example, but, it closely resembles a case that we saw in the past where, this retailer had multiple terms for a large number of their suppliers. So, for example, there were 1,500 parent vendors with 2 terms, there were 500 vendors with 3 terms, and so on down that list. And, vendors with multiple terms made up about half of their spend, right? So that's a big opportunity. And it was so prevalent with them because, they had messy data in the first place. They recently acquired a large company, so they brought in their suppliers as well. And then they also have multiple banners that were fairly, disparate, geographically and just in the way they operated, right? So one banner would negotiate one term, but another banner would negotiate another term for that same supplier, right? So it was kind of like a perfect storm to rationalize these terms. So on the right-hand side is an example of one vendor that had 4 different terms, and they were being used across 6 of the client's banners. So if you look at that list of terms, they're paying a small chunk of their spend upon receipt, which is basically a pay immediate term. So right when they received the order, they had to pay it, which is not favorable to DPO by any stretch. And they also had, they had a majority of their spend on 2% 10, net 30, which many retailers would view as favorable because they're getting a 2% cash discount as well. They had 10% of their spend in net 30, and then about a quarter of their spend in net 60, right? So ideally, you can move all that spend to either 2% 10 or net 60, depending on what you view as more favorable. So, companies have to take into account cost of capital. So you can compare those different terms apples to apples. And, typically from what we've seen in the past, 2% 10 is more favorable because every 1% discount usually equals anywhere from 30 to 45-ish days. So, that's a whole other topic, but that's kind of how you work out the math with equivalent terms. Back to this example. So if you were to harmonize all the spend to the best term here, it could really result in substantial cash flow gains and possibly EBITDA gains as well, without being too controversial because the supplier is already giving you those terms just in another banner. So that's why they're considered, quick wins as opposed to longer, more drawn out negotiations where you're asking for, brand new terms that you don't already have. And it's not as simple as saying, okay, let's automatically move to the best term currently. So sometimes you're buying products in multiple categories from these suppliers, right? So maybe you're getting higher terms in categories with higher inventory turns, such as packaged foods, as opposed to something fresher, such as dairy, where it's lower. So you need to take that into consideration as well. But then also you need to look at the amount of spend that you have currently on those terms. So in this example, if there was let's say a net 75 or a net 90 term, but with only 1% of spend, it wouldn't be as realistic to ask that we move all the spend to that term, just because it's pretty low in spend relatively. But again, overall, this is kind of where you can find quick wins, and they definitely add up, especially for certain clients that have all these suppliers across different systems. Okay. So on the next slide, so this is where we get into the use of playbooks for strategic suppliers that make up the top 80 to 90% of your spend base. And they're higher spend, but they're also higher risk because if you handle negotiations incorrectly and you're too abrasive, it could definitely disrupt your business, right? So these typically these new term asks, as opposed to just quick wins, they're brand new terms asks, right? So they incorporate a lot of fact pack information along with parent-child relationships to get you an accurate picture of your total vendor spend and metrics, right? So let me just walk you through this graphic on the left. So this is really an example of what a playbook can contain. So it has external supplier metrics from the fact packs. So DSO or day sales outstanding measures how long it takes the supplier to get paid. overall. So it's a good comparison because if your DPO or your days to pay to that supplier is shorter than the time it takes that supplier to receive payments from all their customers, then there could be a good case to extend right there, right? So we show DSO last year, we show the latest 3-year average, and then we also show the supplier's own DPO, just to see how long it's taking them to pay their own suppliers. So if you look at the DSO and the DPO in tandem, you can really get a good look at, their own working capital situation. And if they're doing really well, you can make a case that they wouldn't be as adversely affected if you extended terms on them at some point, right? So we also show a terms range in the region. So it's typically the payment terms that we see for that supplier across the entire industry, and not just for that specific client. Credit risk and cost of capital can be helpful. And then just some internal metrics as well, just show the client how big that supplier is relative to their supplier base. And also if they're a global supplier, and then what segment that we put them in. Back when we did that supplier segmentation exercise, which we typically do at the beginning of each engagement. And so in the middle section, we show some internal metrics. So not external, but internal for that supplier at that client. And we're actually using, the terms and the payment data to measure current performance at that client. So we break it out by banner. If they have multiple banners, we show total spend, the primary payment term, which is the term associated with the highest spend. Any other prominent terms, we show days to pay, which is actually measured at the transactional level. So, it takes the payment or the check date minus the invoice date or, the date of goods receipt, whichever one is used as the payment clock start date. And then what we do is we roll it up at, the banner level and total vendor level using some type of weighted average by spend. And so it's different than DPO because, DPO is more of an accounting calculation, while, this is a true transactional level calculation. So usually the two measures are fairly similar, but they're definitely not the same, right? So we also show if they have an early payment cash discount. We show any other rebates outside of payment terms, along with the total margin with that supplier as well. Keep moving to the right. So we also show days on hand or days of inventory on hand. And that's actually a pretty powerful metric when compared to payment terms, because, if you're holding inventory for a lot longer than your payment terms, that can be a legitimate case to extend terms to more closely match up with your inventory turns. Then we also show some financial benefits for each day of DPO improvement as well, and then category target days. So, in another exercise that we do in tandem with this, we typically set category terms targets for the non-strategic supplier base. And that's based on, category metrics and typically what we see in the industry. So it is helpful to see those targets compared to current terms, for specific suppliers in core grocery, for example. And then on the very bottom, we show, internal metrics broken out by the main categories or merchandise groups that the supplier is in with our client. So again, this is just a start, and it doesn't include the full picture, but it does contain a lot of, the key talking points that clients can use in negotiations. And so when you bundle all this info up, it's good to prepare some type of terms guardrails, which is on the right-hand side. So what we have here is, you have your terms ask, the alternative, which is typically just an equivalent term with the cash discount. And then again, this relies on the client's cost of capital and risk preference to get that alternative equivalent term. And then you have a terms fallback, so what the client would settle for if they couldn't negotiate the ask. And then, an absolute requirement. So in some cases, it's just, harmonizing terms, especially if there was some recent M&A activity and terms are different across the two companies. We try to standardize those together, or, some type of payment frequency change where, they're moving from paying daily or twice weekly to just once weekly, which is pretty common, especially in certain regions. And it helps the client extend their DPO as well, making those frequency changes. So For this specific supplier, we're asking for net 50 because, there's quite a few metrics that support that, which I'll go over in a second. The equivalent discount term is 2% 20. The fallback is net 45, which aligns with their core grocery standard term. And then, the requirement is at least standardizing terms between banner A and banner B for that supplier since they are different. So if you go to the bottom, that's just more of an easy way to match up the current performance with all the other metrics I just discussed, right? So pretty much, the greater number of bars that are higher on the right-hand side than the ones on the left, the stronger the case you had to extend terms, right? So just going across, current terms are either 40 or 30 days. The weighted average is 37 because there's a little bit more spend on the 40-day term. The days to pay is 39. So it's normal that, days to pay is typically a couple days longer than the payment terms are just due to, payment frequencies and other policies that the client has in place. In this case, days on hand is actually a lot higher than the terms. So again, that's a strong case right there. And it also helps that we typically see terms for this supplier at net 50 in the industry. And then their own DSO and DPL metrics are, much higher than the current terms that the client has with them currently. And just one comment on the DPO. So it's kind of an interesting piece because, sometimes these suppliers actually can extend their own terms with their own suppliers. And, sometimes they do it kind of unilaterally and it gets bad press. And, there's suppliers complain about it because they don't get much say. But so, for example, like Unilever extended to 90 days a while back. I think it was like 9 or 10 years ago. And Procter & Gamble also went from 45 to 75 days at some point for direct goods. And I think they went to 90 days for indirect goods. And there's an article about it. They freed up an extra $1 billion in cash flow, right? So that was a major boon for them. And, it's not always a zero-sum game. They can actually help their own suppliers and create some mutual value and benefits for both parties. And the way they frame it is, they can use that extra working capital that they captured and, benefit their own supply chains and buy larger purchase order volumes from their suppliers. So it can help their own supplier base, even if it hurts their own, working capital in the short term. So, and I think our clients can frame it that way as well, with these large suppliers, and that they can use this working capital benefit to, and kind of put it back into investing in their relationship, whether it's, buying higher volumes or whatever. One thing that's also not mentioned here is it's important to develop carrots and sticks. And so kind of the benefits or the reasons to entice the supplier or to increase their terms, that's what the carrots are. And then potential sticks or fallbacks kind of if they aren't compliant with the terms change. So for example, we're going to buy more product from your competitor, and obviously some of these vendor relationships are very delicate. So they try to do it in a way that's not abrasive, but that's one example of, carrots and sticks that can be helpful. But, overall, this bar chart can really just help quickly identify that there's, certain metrics that can help support a terms increase if they do exist. And then real quick, 'cause I know we're running out of time, this last slide here just shows a couple of examples of what, we've seen and some of the main reasons our clients were able to extend terms with these suppliers. So, the first one is a major electronic supplier, and we anonymized the name, but, the prior year they had net 45 terms with the client, but then they actually had a terms decrease to net 40, right? So that drop in terms actually wasn't warranted or justified, based on other metrics. So in the EMEA region, the supplier actually had 60-day terms with the client. The primary terms with their competitor was net 75. So that's a huge gap right there between net 40 and net 75. And then also the supplier's own DSO was 65 days. So, there was no real justification for the lesser terms. They're able to actually extend terms back up at some point using some of these metrics as performance metrics. And then another example at the bottom there is a meat supplier that actually decreased terms by a day with our client. And, they had an opportunity to at least harmonize terms within the banner because they had two other more favorable terms with a cash discount that they were already using. So again, the client was able to go back and successfully negotiate that more of their spend was, kind of transferred onto those other terms that they currently use. All right, I will hand it over to Michelle now. Or sorry, to Adam now.
Yep. So I think, so I think in summary, like, what we're really trying to illustrate here is just the more data that we have, the more competitive that we could be with our analytics, and the more value that we could capture with our analytics. And so as the market's increasingly getting more competitive, the more facts that we can bring to the table, just the better insights that we're going to be able to develop. Like similar to Dan's examples here, like if we just know what our payment term is, like we don't know what action we could really take with that data alone. So, that's data that exists, but as we start to build on that and bringing in more data, it just gives us more opportunity to really, create value for the organization and capture that value. And, likewise with the, parent-child information, what quick wins do we have? Like, do we have 10 different payment terms with the supplier? Do we have, margin performance that drastically varies from, one child to another? So, having that information together just really helps us build, that insight and really help identify where we could go out and capture that opportunity. And I think lastly, like just, especially in 2020, the market is, very volatile. So, the more information that we could have, from our suppliers that they're reporting publicly, and we talk about public suppliers because they're also, the bigger ones and the more, important suppliers to our business as well. So, as one public supplier is, having issues, like, that's one of our bigger suppliers as well, most likely. So, that's, really that insight into what's going on with their business. How is this market condition impacting their business? It just really helps us, prioritize, where should we be trying to capture that value? Should we go after a supplier that is having, historic sales through this process, or the one that is having historic losses in the process? So it really gives us the information to make the best decision and really help us support our asks. So we hope you captured that information as we've gone through this webinar with you guys. So now I'll hand it to Michelle.
Great. Thanks, Daniel and Adam. So we do have a couple of questions. Just in the interest of time, if I'm probably just going to do one. And you kind of touched on it, I think, in your summary there, Adam. Why is enrichment important in negotiations?
Yeah, we really think the enrichment's important just to give you the most available facts that you could have to negotiate with that supplier. Like we hear, all the time from, people in the negotiation room that, the supplier comes to us with so much data, they have so much more data than we do that, we can't really respond to their data because we have very little data going in there. So the more data that you have and that, more preparation that you take on the front end with the data and the analytics, just the more responses that you can go back to the supplier with. It's like they come saying, well, this commodity is increasing and we're going to have to increase your prices. You pull up your commodity sheet, it's like, well, I see that commodity is flat. So it just gives you more leverage to, have all the facts on your end as well and not rely on what the supplier is telling you.
Great. Well, thank you all for attending this webinar today, and also a big thank you to our presenters, Daniel and Adam. As a reminder, this recording will be added to our PRGX website in the resources section. You'll also find some of our other on-demand webinars listed there. If you'd like to know more about the advanced analytics that Adam and Daniel spoke about, recovery audit, or just to speak with a PRGX expert, please be sure to visit our website at prgx.com. Thank you again for joining us today. Have a great day.